Hello traders, welcome to FreeFX with me, Francesco Sani. Today is the 8th of May 2016, and as part of my beginner series videos, I'm going to discuss a topic today that was suggested by forum user Marcaria400 on the website babypips.com forums. So the topic of the day is hedging. And this is one that is quite interesting, so I'd like to get right into it. So the first item here is a definition of a hedge. So you find various definitions. You can go on to Investopedia or Google or a dictionary, and you'll find that there are different ways to classify a hedge, financially speaking. But really, it boils down to one thing, which is managing risk. So when you essentially buy a product, you then, let's say you buy a car, typical example, or a house, and then you purchase insurance against it. So in the event of theft or an accident or fire or loss, then by purchasing a car and purchasing insurance, when you lose a car, for example, then purchasing of insurance protects you against loss. So essentially, in financial products, this is the same function of managing risk, and that's what hedging means. Now, this can be boiled down to different ways of hedging, and indeed there are many ways to hedge, but the classic one that was done in the late 40s, early 50s by Albert Jones was that of introducing a counterbalance to buying stocks and actually short selling them at the same time. So this provided insurance against loss in case of reversals. That approach to the market is where hedge funds stem from, and that is where the word hedging comes from, essentially. And we're going to start looking at this, so our second item, which is simple versus complex hedge. A simple hedge is where, for example, you have buy euro US dollar, sell euro US dollar, and if your broker allows you that, then that's great. That's quite straightforward, which means basically you have two positions open on the same pair, so that if you're wrong on one position, your other position is there to counterbalance things, because you probably have the same spread being the same pair bought and sold, and so on. Of course, there are other implications, but we'll come to those later. The complex hedge is where you involve different pairs, so that you can use multiple instruments. For example, you buy euro US dollar and you sell pound kiwi. Now, that relationship isn't at first very straightforward, but it could be constructed through a number of steps. But the article here from aboutmoney.com goes into Forex options as well, so that's buying different asset classes altogether. But again, options, futures, etc., are all ways to hedge your risk if you are in spot Forex. So just things to think about, really. And going back to our sheet, the third topic to talk about then is currency correlations. Why is that so important? Well, if you go onto babypips.com, you find that correlation is treated in this part, and it tells you about currency correlations, how they change, and so on. And you also find that it shows you a table here, and it tells you about diversifying risk and how to do that. So essentially, all currencies are correlated in some way, because there are different movements in the market that can affect several currencies. And when we're talking about, for example, the majors, the 7 currency pairs that are pegged to the dollar, then if the dollar moved in a big way in one direction, all those trades will be affected in the inverse. So you have to really think about, if you're trading several dollar pairs, are you really diversifying, or are you just doubling up on the same risk potentially? Now let's just go to the map that I have here from oanda.com. This heat map has a neat way of representing correlations going from the 1 hour to the 1 year period. And so, for example, if you want to compare the euro pound with the pound US dollar, you'd expect them to have a negative correlation because the pound is on the opposite side of the equation here. So if we looked at the 1 day, they had a very strong positive correlation, which means they move together. But as you go further in time, 1 week, 1 month, 3 months, 6 months, more year, they all have a negative correlation. So, for example, if we looked at the Kiwi dollar and pitch that against, I don't know, for example, another major like the pound US dollar, you see that the two have no correlation on the 1 hour and the 1 day, the 6 months and the 1 year, and then 1 week, 1 month, and 3 months. They had an increasingly smaller positive correlation. Positive correlation means that two pairs move in tandem. Now this is probably due to the fact that these two pairs essentially are being paid to the dollar, are subjected to the same movements because the dollar maybe is the driving force. But that may not be the same case as, for example, the pound US dollar and something like the Kiwi yen. So let's compare these two. Pound US dollar and Kiwi yen have a very strong negative correlation, so they're inversely related, and very strong positive correlation in the 1 year, 1 week, and then the 6 months. Now, all these correlations, all that this map can do really is show you what you may already suspect, and it's limited really because it goes up to a year, but it's a very, very, very good way to check correlations. So do try this free resource because it does help you bring things to life. And then having checked the babypips.com score here on the high score and currency crosses, you see that there are a lot of things that one can try. So let's close this for a moment and go to synthetic pairs versus hedge. So essentially, you have to think about whether it's worth hedging one pair with another, or just getting hold of a synthetic pair. This is a different thing altogether, but it's something that made me think about hedging and the true reasons behind that. For example, let's say that you have a positive bias on the euro and a negative pound bias, so we call it plus minus. There is a pair, obviously, and this is a so-called synthetic pair or currency cross, and this pair is basically allowing you to buy euros and sell pounds, okay, or vice versa, obviously, sell euros and buy pounds. So if you had an analysis where you saw the euro across the board were appreciating and that the pound across the board was depreciating, what would you do? Would you just sit on your laurels, or would you try to capitalize on that? My suggestion is that you try to capitalize on that in one same pair by buying the euro and selling the pound using the synthetic pair, the euro pound, which is tradable pretty much everywhere. The sort of hedge way would be to buy again against dollars, euro US dollar, okay, and then to hedge that, for example, with selling the pound dollar, okay. Now this is a slightly different scenario from buying euro and selling pound in the euro pound scenario, and I'll leave you to make your own conclusions of that. Basically what we're trying to say here is that if the euro, okay, were rising and you buy euro US dollar, great. But if the dollar were rising here, okay, and it would also rise here, and you've gone short this one and long the other, you basically be making money on the pound dollar pair and losing money on the euro dollar pair. So that would be a way of hedging that. But more similarly, you could just buy euro versus the pound, okay? Because maybe your fundamental analysis gave you that scenario. So again, sometimes considering that if you're hedging, you're also doubling on risk. Potentially, you have to think about the spreads as well, the rollover, etc. So you got to think about those things. And therefore it may be worthwhile just thinking really carefully whether it would be more manageable, for example, to buy a cross currency pair which had both your biases fused into one. Anyway, that is another point, which takes us to the technical versus fundamental argument on number 5. This essentially is this. And I sort of declare an interest here because I am hedging in the following way. I am currently selling the euro pound, and I am also long the pound kiwi. So that means essentially that I am doubling on pound strength. Essentially, I am buying pound on 2 pairs. Okay, because if I'm selling euro versus the pound, I'm buying the pound, and then I'm buying it again versus the New Zealand dollar, so that's a double long on the pound. However, there is something slightly different going on here. Of course, I'm confident that the euro is basically overvalued and that it must come down. And that even if the pound didn't move particularly well in the because maybe the euro didn't move particularly strongly and didn't make much progress, I would then have a pound kiwi where the kiwi has been losing ground. Therefore, my pound long that might not be going very far in the euro pound short might work better in a way hedge a lack of profit from the euro pound short through counterbalancing the Kiwi dollar that was falling. So this is also a complex way of hedging. But what do I mean by technical versus fundamental? Well, okay, so let's say that I am then long the pound over these 2 pairs, and let's say that I wanted to counterbalance that long exposure with something that was inversely correlated to the pound. And this is one of my other trades, which is this is the UK 100 shares index, or FTSE FTSE index, and this is an equities index. So let's say that I went short, which I have, and that I did so in the belief that the FTSE 100 had an inverse correlation to the pound dollar. Okay, but I went to look for that, and I found that actually the correlation between the FTSE 100 and the pound US dollar has been fluctuating, even having a positive correlation, meaning the two went hand in hand. When I started trading it last summer, I actually came to the conclusion that technically that may have been the case, but fundamentally this was probably a good hedge, Why? Well, let's explain this. When the Bank of England decided or will decide to have a rate rise, then this will be pound positive, and it will be meaning that the pound is becoming a vehicle for investment, but also that the bank is taking away its stimulus, and it is becoming a funding currency. So the pound is appreciating would be appreciating with more rate rises, and there will be a great opportunity there for people to come out of equities, for example, invest in pounds, and basically not see the Bank of England as supporting the pound equities anymore without the sort of quantitative easing behind it. So in a way, if the Bank of England were to raise rates, this would be pound positive, but also it would signify that there was not enough appetite for investors to continue buying the FTSE 100, which has been declining in the last few weeks, actually days. So this basically would mean that a strong pound positive move would be negative for the 100 shares index, the FTSE 100. So that is a fundamental hedge, because although there may be some temporary correlation between pound and FTSE that is positive, it also is fundamentally actually opposed. And I'm just going to show you one more thing. This is the indeed the FTSE 100 equities index in blue, and I put it as a line rather than candlesticks because you can see the two lines better. Okay, this is a day chart, but it goes back to 2013, late 13. So you can see over at least 2 years, 2 and a bit years, that these two have a correlation. Now, if you look at this area, you notice that there is quite a strong inverse correlation, so that when one goes up, one comes down. This is in the period of 2015 mostly, and you see this strong inverse correlation. Then it becomes a little bit more muddled around here, where so after this period you see that one comes down and one chops up and down but also comes down, and then from early 2016 you start seeing this correction. Let's see, FTSE 100, here's the pound dollar at the bottom in green. They're both sort of rising, but really fundamentally, given this large period where they moved in opposite directions, and given the perilous state of the FTSE 100, I think this is risk aversion. I think the FTSE 100 is due for a major correction, and when it will be due for a major correction, maybe we'll see truly if the pound and the FTSE 100 still have this correlation, or whether it will just be forgotten about. But essentially, it is important to think about correlations as changing paradigms. So it is not something to be set in stone for an entire year and making a strategy or trading system that repeats itself based on that information. It does change over time. So we are sadly out of time, so I'm going to wrap it up there, and I hope you have a great continuation of your weekend. Please leave comments, and I'll see you in my next video. Thank you very much for listening, and goodbye.